100% bonus depreciation is back, and this can mean massive tax savings for real estate investors, short-term rental owners, and high-income earners. Thanks to the newly passed One Big Beautiful Bill, this popular and powerful tax tool has returned. In this video, I'll break down what's changed, who qualifies, and how you can use it to save up to 5 to 6 figures in taxes legally. So what is 100% bonus depreciation and why does it matter? Well, when you buy an asset, you're typically not going to deduct its full cost in the first year that you acquire it. Instead, you're going to depreciate that asset over several years, and you're going to deduct a little bit each year over its depreciable life. Whereas with 100% bonus depreciation, you're able to fully deduct the cost of assets with a depreciable life of 20 years or less in the first year you acquire that asset, which adds up to substantial deductions and often leading to substantial tax savings, which is why 100% bonus depreciation is so powerful. Now, business owners can certainly take advantage of 100% bonus depreciation if you're going to be acquiring assets for your business that have a depreciable life of 20 years or less. But another group of people who's going to be able to benefit from this tremendously is going to be real estate investors, and that's where we're going to be spending a lot of time in today's video. Now, when it comes to real estate, residential real estate is typically depreciated over 27.5 years, and commercial real estate is typically depreciated over 39 years, which is a relatively long period of time and gives you a relatively small deduction over these many years. But when you acquire the property, you're not just acquiring the building and the land. Usually there's components within the building and on the land that have a depreciable life of 20 years or less and are eligible for 100% bonus depreciation. The way you would typically get a readout of what components within your property qualify as 20 years or less is through a cost segregation study where an engineer comes down to your property and gives you a report of what the breakdown is. And often this could be substantial, anywhere from 20 to 30% of your property's value can be allocated to components with a depreciable life of 20 years or less and are eligible for 100% bonus depreciation, which leads to substantial deductions and substantial tax savings in the first year. We'll break down an example of what this looks like in more detail later on in this video, but the return of 100% bonus depreciation is massive. Now, this is nothing new. 100% bonus depreciation was originally introduced in the Tax Cuts and Jobs Act of 2017, and it was effective from the tail end of 2017 through 2022, where it began to phase out starting in 2023 when bonus depreciation dropped from 100 to only 80%, and then phased out an additional 20% in 2024, and it was set to be fully eliminated by 2027. However, the One Big Beautiful Bill reintroduced 100% bonus depreciation starting in 2025 with assets that were acquired and placed into service after January 19th, 2025, and it is now permanent, meaning there is no phase out, there is no cliff. 100% bonus depreciation for assets with a life of 20 years or less is now the norm, and this is going to lead to a substantial wealth building period for business owners and real estate investors who are able to take advantage of 100% bonus depreciation. So who exactly can take advantage of this and how is it done? Well, the first group is going to be business owners. If you own a business and you're acquiring a lot of assets with a depreciable life of 20 years or less, you're going to be able to fully deduct that using 100% bonus depreciation or Section 179, but we're not going to cover that in today's video. And you're going to be able to get massive tax deductions and thus tax savings as a result. Now, when it comes to real estate, things are a little bit more complicated. That's because as a real estate investor, the tax code considers your rental properties to be quote unquote passive by default. And what does that mean? That means that any losses generated from your rental properties will not be able to offset your W-2 or active business income unless certain criteria are met, and we'll get into that. Instead, it's only going to be able to offset other passive income. All right. Now, you might be wondering at this point, well, Tom, I don't want to take a loss on my real estate. Why do I want to take a loss? Well, the thing is about depreciation and 100% bonus depreciation is that is a non-cash expense. It really only exists on paper. So it's quite possible that you tell the IRS, hey, I lost money despite the fact that you're generating positive cash flow. And that is just another reason why bonus depreciation is so great, because you're going to be able to generate substantial losses. And if you could use them properly, it can lead to a lot of tax savings. So let's go ahead and dive into the real estate aspect of it a little bit more. So if real estate is passive by default, how do you get around this? How can we take these losses and use it to offset the W-2 income or active business income and really make this strategy powerful? Well, there are two main ways of doing this. The first way is going to be qualifying as a real estate professional, or for the real estate professional status, also known as reps. Now, to qualify for reps, you spend more than 750 hours and more than 50% of your total working time in a real property trade or business. This effectively means that you're a full-time real estate investor. And when you do that, you'll be able to take the losses from your long-term rentals or your mid-term rentals against your W-2 or your active business income. Now, here's where things get a little tricky with the real estate professional status. You need to spend more than 50% of your total working time. And if you have a full-time W-2 job or you're running a full-time business, it's going to be virtually impossible for you to qualify for that, as proven through many tax court cases, IRS audits, so on and so forth. So what can you do? Well, the first thing that you can do, a pro tip, is that if your spouse can qualify and you file a joint tax return, then you both can take advantage of it, meaning the losses from your rental properties can offset your W-2 or your active business income. And we see that happen all the time. One spouse is a high income earner, they're running a business, the other spouse manages the real estate and qualifies for the real estate professional status, and they're all good to go. What happens if you can't do that? What if you're single and you have a full-time job or business? Or what if you're married and both of you have a full-time job or business that's not in real estate? Well, what do you do then? Enter the short-term rental loophole or the short-term rental strategy, whatever you want to call it. It's investing in short-term rentals and doing things certain ways. Well, that's where we get to short-term rentals. You can call it the short-term rental loophole. You can call it the short-term rental strategy. You can call it investing in short-term rentals and meeting certain criteria. This is a powerful unlock, and let's break that down. Now, when it comes to short-term rentals, your typical Airbnb or VRBO property, they can be treated differently than long-term or mid-term rentals when certain criteria are met. The first one is that the average period of customer use is 7 days or less for the year. When this happens, your property is no longer considered a rental. It's no longer considered passive by default, meaning you don't need to qualify as a real estate professional to take the losses against your W-2 or your active business income. Instead, all you have to do then is materially participate. Now, there are 7 different tests you can meet to materially participate. I cover a lot of them here on this channel and other videos. I'm not going to go into an in-depth breakdown here, but the most popular one is that you spend more than 100 hours managing your rental properties and no one else spends more time than you. And this allows you to hire repair people and cleaners to help you kind of manage your property without tripping up these rules. Okay, and that is how it's done. When you do these two things, you're 7 days or less, and you materially participate, your short-term rental is now non-passive and you don't need to qualify for the real estate professional status. So you can effectively do this part-time, and that's why it's so powerful for high-income W-2 earners and business owners who don't work full-time in real estate. So now let's break down an example of what makes it so powerful. Again, if you're a business owner, you acquire an asset within your business that has a useful life of 20 years or less, you're just gonna be able to deduct it using 100% bonus depreciation. Relatively simple. If it was $20,000, you're gonna get a $20,000 deduction. But with real estate, again, things are a little bit more complicated. And we're gonna go back to our example, our single family house that we bought for $500,000. If you remember, the building and its components were $400,000 in total. And if you just did straight line, regular depreciation over 27 and a half years, your deduction would again be roughly $14,500. But now let's see how 100% bonus depreciation really moves the needle. All right, so that $400,000 that's allocated to the building and its components, there's going to be components in there that are depreciated over 20 years or less. Again, it's usually gonna be somewhere between 20 to 30%, depending on the type of building, depending on the location, and many other factors. But for the sake of illustration, let's just assume that out of this $400,000, you go ahead, you get that cost segregation run. Again, a cost segregation engineer comes to your property, gives you a readout, gives you a report on the different breakdowns of the breakdown of the components within your property. Okay, so let's just say that they give you that breakdown, and 25% comes back with a useful life of 25 years or less. All right, so 25% of that $400,000, we're looking at $100,000. Now, with 100% bonus depreciation, you're now deducting $100,000 in the first year you buy that property. And remember, this isn't $100,000 that you actually lost. This is $100,000 that only really exists on paper. And what's oftentimes going to happen is that when you're going to have your rental property, you're going to have a profit and loss statement. You're going to have your revenue, which is your rental income. Okay, you're going to have your operating expenses. These are tangible expenses that it costs to actually run your property, repairs, maintenance, property tax, utilities, things of that nature. But then you're going to have this big line, you're going to have this line item called depreciation, and it's going to be pretty massive in that first year thanks to bonus depreciation. And that massive expense is going to lead to a substantial loss. Now, for the sake of illustration, let's just assume that between depreciation, bonus depreciation, and your operating expenses, you end up with a loss of $110,000 in that first year. And you qualify for the real estate professional status if you have long-term or midterm rentals, or if you're using a short-term rental and you qualify for, you meet the criteria that I mentioned, then that $110,000 is going to be deducted against your other income. It could be income from a business, it could be income from your W-2 job, whatever the case may be. Let's just say you're at the 24% tax bracket. That's going to yield you $26,400 in tax savings. Now, if you're in the 37% tax bracket, that is going to yield you $40,700 in tax savings. Now, that's money you're putting back into your pocket that you would have otherwise had to pay the government. Now, what you do with this money is completely up to you. You can go spend it, you can go reinvest it back into your business. That's what a lot of business owners and real estate investors will do. Take it, reinvest it, and continue to use it to build their wealth. But the point is that 100% bonus depreciation, the reason why it is so powerful and so important is because it is giving you substantial tax savings in that first year you acquire the asset, which is oftentimes used to reinvest and continue growing your business, growing your wealth. Now, with all that said, the combination of 100% bonus depreciation returning, as well as strategies like the real estate professional status or investing in short-term rentals, can be quite powerful. However, there's a lot more nuances to each of these strategies I simply cannot cover in today's video. So I invite you to check out some of the other videos here on the channel where I do go deeper into the real estate professional status and investing in short-term rentals. But that's still not a substitute for working with a qualified professional who can help you navigate the strategy and apply it to your situation so that you can maximize your tax savings as well as remain in compliance with the IRS so you don't end up in hot water if you're ever audited. So if you like this video, go ahead and hit that like button, as well as subscribe to the channel so you don't miss out on future tax savings videos. If you do want to work with a CPA who can help you navigate this and apply this to your situation, I do invite you to schedule a free discovery call. I will put the link to do that here in the description of this video. But until next time, happy investing, and I'll see you on the next video.